Unit 1, we're going to look at the nature of accounting. So to start with, our unit in financial accounting begins with what is called bookkeeping, where you're going to learn the difference between bookkeeping and accounting, and also we're going to explain the various business types and the fundamental elements involved in accounting. By the time we're done, you should be able to differentiate between accounting and bookkeeping and cost and management accounting. You also should have learned how to describe the different types of businesses and the fundamental elements that you need to know in accounting. So you also need to use the accounting equation to show the relationship that exists between those fundamental elements. So to start with, bookkeeping is simply a systematic method of maintaining accurate and complete records of daily financial transactions of a business. So the first step in the accounting process is bookkeeping. To start with, what is accounting? So accounting has been defined by different scholars, but we can define accounting as simply the process of analyzing, classifying, recording, summarizing, communicating, and interpreting business transactions and events. These are usually expressed in monetary terms. So as accountants, we always use a monetary term whenever we're describing assets and liabilities. So I'm going to start with basic terms that you need to understand. To start with, what is a business transaction? When you're dealing with a business transaction, in accounting, we're actually dealing with an event which is expressed in monetary terms. And this is a transaction that is capable of being recorded in the books of accounts. Examples of transactions that we're going to look at are transactions like buying goods, which are called purchases, selling goods, which are called sales, paying wages, or expenses in general. So we have the following types of businesses in which these transactions will occur. We have what is called a sole proprietorship or sole traders. We have what we call a partnership. We have what we call companies and cooperatives. So each one of these ones here are examinable. You need to understand or know one or two things about them. When you're dealing with a sole trader or sole proprietorship, this is the most common type of business, which is owned by one person who is in charge of the day-to-day transactions. This one makes all managerial decisions and he enjoys all the profits. And if he fails, he suffers all the losses. So examples of sole traders, we're looking at workshops, a trade store, a cantemba. And these ones have what we call unlimited liability. This means that the debts of an individual will go to the individual assets that a sole trader or sole proprietorship may have. After sole proprietorship, he graduates into what is called a partnership. This is a type of business which is owned by two or more individuals. These are called partners. They have an agreement which is called a partnership deed. This partnership deed stipulates the amount of resources, which is called capital, and how the profits will be shared out. This partnership for professionals like accountants and lawyers is limited to 20. So the partnership may benefit the owners because they will share the risk. It disadvantages them because they will also share the profits. Generally, individuals are selfish, wanting more to themselves. So partnership also has unlimited liability, meaning the errors and the debts of the partnership will go to the individual members. Of course, sometimes we have people we call limited partners. These ones are limited to how much they invest. Then we go to what is called a company, which is by law created in Zambia under Cap 388, where a company shall assume a personality. this company will have an ability of a human being, a person, can sue and be sued. Company, on the other hand, has a larger pool of resources because it can borrow money from banks and larger corporations. The ownership in this kind is in the hands of people we call the shareholders. These are the people who contribute monies towards capital, and this money is called shares. The shareholders will also elect directors who, on behalf of the directors, they'll appoint managers who manage the company. Then finally, we have what we call cooperatives. This is another form of business which is owned by its customers. The purpose of a cooperative is simply to provide a common service to its members at a lower cost so that they could earn a profit. Cooperatives are being encouraged time and again. In Zambia, cooperatives are being encouraged, especially in the mining areas, where people will have what we call a social profit, where people can borrow at less interest rates and also plow back to ensure that this kind of entity has a longer life. So the profits that are made are distributed to its members in proportion to the amount that each member has put. So the difference between accounting and bookkeeping is in the types of businesses that are being owned. So we're going to go quickly a little bit further, where we're going to look at the elements that are involved in accounting. So the elements that you need to understand are issues to do with assets, liabilities, and equity. These are related in the following ways. When you're dealing with assets, we're dealing with what the business owns to generate cash. There are three main types of assets that you need to know. They are what we call the current assets. They are also what we call the fixed or intangible assets. So the fixed are the tangible, the intangible, we'll talk about them later on. So when you're dealing with current assets, we're looking at assets that are easily converted into cash within a period of 1 year. So the current assets that a business may have are issues like cash, accounts receivable, these are our debtors, the people that owe us money, inventory, which we also call stock, prepayments, which we call money paid in advance. So the current assets are called current because they can be converted into cash within a short period of time. Then we also have what we call the fixed assets. These are the assets that are used in the normal operations of a business. The fixed assets are also called capital expenditure because they are meant for normal operation. So assets that are sellable, like cars, are called inventory. They're meant for resale. But if they're used in a business for operations, they would in turn be called capital expenditure. If they're used for sale, revenue expenditure. So examples of fixed assets are buildings, we have equipment, we have land and vehicles. Then we also have what are called intangible assets. Intangible assets are simply assets that provide benefit to a business entity for many years, but they have no physical substance. The intangible assets can be goodwill, the patent, the trade name, etc. So goodwill is simply a good name that an institution or a business could have, and people will buy the name for to trade. For instance, Total. If you want to open a filling station, you buy the goodwill. This is an intangible asset for you to operate under their name. This will be a cost because it has taken time for an institution like Total to really have a name that it has established in the years. Are we following? Are we together?
Yes.
Yes.
All right. Then when you're talking about liabilities, Liabilities are simply the debts that a business owes its creditors in terms of service. So if I received a service and I didn't pay for it, it's called a liability. If I received a good and I did not pay it, it's called a liability. So if a business borrows money, it becomes a debtor. And the person or business to whom we borrowed money, that person is called a creditor. So if a business fails to pay its debts when they are due, the creditor can claim against the assets of the business as a whole. So there are two key terms we've talked about. We have a debtor, the person who owes us money, a creditor, the person we owe money. Then we go to what is called owner's equity. When a business starts, it has no money. So what happens is the owners will need to put in money or borrow to start with. So that money that the owner starts is what is called the owner's equity. So this equity or capital which start with belongs to the owner. So in a partnership, it is called a partnership or equity. In a company, it's called the shareholders' equity. So in other terms, for a sole proprietor, we can call it the present worth or the net worth. All these mean the same. So the money that we start with is simply equity. So owner's equity increases when the money invested in the business is added or is increased. So the owner's equity will increase when the money invested in the business or through a revenue generated through sales. Sometimes owner's equity will decrease when the business will withdraw for personal use. Those withdrawals are called drawings. So drawings will reduce the owner's equity or the capital. So when we decide to open a cantemba and we don't have mini meal and we decide to use that mini meal for home consumption, it is called a drawing. So that reduces our equity. Also, sometimes we may want to use that money for business use to buy capital expenditure, such as a computer. So it also reduces our equity. So before we continue the discussion, let's try to have a 5-minute review. So in the following, list items, whether they're assets, whether they're liabilities, or whether they're equity. Cash at bank, what is this?
An asset.
An asset. Money from the business owner. What is this?
Equity.
Equity. Furniture in a business.
Asset.
Asset. Money owed to creditors.
Liability.
Liability. Business loan from the bank.
Liability. Equity.
Business loan from the bank.
Liability.
Business loan from the bank, yes. Liability, yes. Then we go to business trade name.
That's equity.
It's an intangible asset. It's a goodwill.
Oh,
All right.
Yes.
You agree, right?
Yes.
Okay, now we want to look at the relationship between the fundamental elements. So there's what is called an accounting equation. The accounting equation is a simple way which we use to show three key elements and how they relate: assets, liabilities, and the owner's equity, and how they relate to each other. So to start with, when you begin a business, you need to invest money in it. So you can either put the money as equity, or you can borrow some of the money from the bank, isn't it? So the accounting equation of a business will always separate your finance into two: the owner from the people we borrowed from. So you should agree with me that without that initial cash put by the owner, a business cannot start. So it needs capital. So to start with, we need to understand that the relationship between the owner's equity and the business assets is given by the following equation. The assets should be equated to equity. And now this will be subdivided into two. The equity that we have above there can be divided as the equity from the owner as borrowed from the bank, and equity from the owner from their own resources. So now the borrowed amounts here are what we call liabilities, and the one from the owner's pocket is what we call the owner's equity. So we have an accounting equation which is given by assets will be equal to the liabilities plus the owner's equity. So now this is one key fundamental equation that you need to know, that this equation shows that a business has assets which are subdivided into borrowed funds and owner's funds. So the accounting equation can also be reversed in any way possible. If you take it this side, since you said assets are equal to liabilities plus capital. So meaning capital can therefore be what? Assets minus what? Liabilities. And also you can say assets minus capital is to get liabilities. So to fortify that, in this example, we are told that Mr. Fay is the owner of the company. He borrowed 500 from the bank to add up his startup capital of 5,000. Therefore, his business had a total of 5,500. So using the accounting equation, we're going to say equity, which is capital, is equal to assets minus liabilities. So 5,500 minus 500 is equal to the equity, which is 5,000. Or we're going to say his total assets are equity plus the liability. The equity is what he had in his pocket, which is 5,000. And the liabilities are what he borrowed from the bank, which is what? 500. So meaning the total assets that he has, we have what? 5,500. So this is where the accounting equation comes in. So this simply means that the amount of the total assets minus the liabilities is equal to the equity. So this therefore means that if a company goes bankrupt, the liabilities are paid off first to the creditors, while the owner's equity will be the last to be paid. So this is what is displayed in a book called a balance sheet. This is what is displayed in a book called a balance sheet. The balance sheet gives you a snapshot of what the business owns. It's a statement that shows assets, liabilities, and the owner's equity at a specific point in time. So the balance sheet has the following format. We have assets and we have what? Liabilities and the owner's equity. That's why a balance sheet must always balance to fortify or to fulfill this equation. All right. So let's look at example number 2. Mr. Fay commenced by opening a business account with a deposit of 5,500. So to start with, 5,500 cash at bank. This is an asset, which is in this case the equity. All right. So if we're going to go into his balance sheet, assets must be equal to the equity here. So 5,500 is same as the capital that he has. Of course, we'll later on go to simplify or expand the balance sheet. But what you need to always understand is that in a balance sheet, each side has always balance. Of course, in the exam, like I was jokingly saying, it never balances, but you should try by all means to make sure that it balances. So we're given another example that on January 3, Mr. Carver made the following cash purchases. He bought a second-hand truck for 3,500. He bought furniture for 1,000. He also bought stationery for 1,000. So now we need to use the basic equation to verify these purchases. So assets must be equal to the owner's equity. So owner's equity, we already know it's 5,500. That's how much he had in his bank. In the assets here, we have what? Motor vehicle, which is the truck, 3,500. The furniture, which is 1,000. And the office stationery, which is 1,000. So when you add up all this, they give up what is called our owner's equity. So still, we are verifying this initial equation. Now, accounting is very important because it has a number of subcomponents that you need to know. But before we go into these simple calculations, I would also want to take you through the key stakeholders of financial accounting. I've shared with you this important book. So there are users of financial accounting information that we need to know. So I shared this book with you, which is by Frank Wood, very important. It will help you on a number of issues. So we need to understand the stakeholders of financial accounting information. They are what we call managers. These ones are preview to this knowledge because they're the ones that do the day-to-day decision making. So they need to know how well things are progressing in a business financially and also the financial status. These ones are the ones that use what are called efficiency ratios to see how well they're utilizing their resources. We also have the owners of the businesses, who are the shareholders who would want to see whether the business is profitable. After all, they're the ones who put in the equity. We're talking about the capital. We also have the prospective buyer who wants, when the owner wants to sell the business, the buyer would want to have such information. What is the bank's balance sheet looking like? The bank also could be interested because the owner would want to borrow money for business use. So the bank would want to see how profitable or viable this business is. The tax inspectors, who in this case, the revenue authority, ZRA in our case, they'll also be able to want to understand financial accounting to be able to calculate the taxes that are payable. The prospective partner also wouldn't want to join a business that is what? Sinking. They would want to know the performance. And finally, investors also, either existing ones or potential investors, also want to know whether to invest their money in the business. So these are important. Of course, the users could be internal and external. You can separate them on your own, but either way, this information is important to both parties. I've explained on the accounting equation and why it's important to have this information explained in form of a balance sheet. So at this point, I'll ask for questions before I proceed. Are we together?
Yes.
So we've also looked at the classification of items that are found in the balance sheet. We talked about the current assets. Current assets are usually recorded in order of liquidity. Cash at hand is usually at the bottom. Then we go cash at bank. Then we go to prepayment. Then we go to debtors. Then that's when we go to inventory. All this is what we own, but in order of liquidity, the one which is usually more liquid is cash. All right. We also have fixed assets. I talked about these are the assets that are used for in the business running day-to-day transactions, investments, and intangible assets like what? Goodwill. Under liabilities and equity, we're talking about the current liabilities, which are debts that are repayable within a short-term period, like bank overdraft. Long-term loan, these are from a period of 1 to 5 years. Okay. And the other part that is in the balance sheet is owner's equity and the retained profits. So quick, can you remember? Write down the meaning of each of these ones. What are current assets? What are fixed assets? What are intangible assets? Quickly, what are these?
So current assets are, these are assets that are, what can I say? Liquid in form, like they're for the, not the day-to-day. How can I put it? I don't know how to put it. But I know the examples of current assets.
What are the examples?
You can say cash, cash at bank, inventory.
Exactly. Okay. Then what are fixed assets?
These are assets that we use for the day-to-day management of like a company or examples are buildings.
Exactly. Then what are intangible assets?
These are more like patterns, like goodwill, investments, or can be an example, or a trademark, or yeah, something like that.
Okay, great. So the intangible. So the current liabilities, these are claims against the assets of a business during the year. Examples are what? Notes payable, tax payable, dividends payable, and trade creditors. Investments include bonds, stocks, and shares. All right. So we are now going to look at something else. So there are concepts that you need to understand in accounting, and these are very important. So the principles that accounts uphold. So these principles and concepts are as follows: is what we call the separate entity assumption, the going concern, the periodicity concept, the money unit assumption, the historical cost, objectivity concept, the revenue realization principle, the matching concept, the consistency, disclosure principle, and the prudence. Now, the separate legal or the entity principle is simply one that states that the business should be separated from the owners. In personal affairs and ownership affairs must not mingle. So should you find the manager using a business car at night later than 21, when the business does not allow, you can sue that individual as a company because they are now abusing their authority. The going concern principle is simply the principle that states that a business will continue for a foreseeable future. It should be valued as if it has a foreseeable future. As you may know, there are people who started a business and died, but their business is still going on a daily basis. So a good example may be a company by Brian Bell, which was started in 1961 and is still going strong even up to now when the founder died. But the business has a going concern. There's also what is called the periodicity principle. Periodicity principle asserts that a business should report the results of its operations over a standard period of time. This period may be a day, a week, a month, a year, or even half a year. This is very important to show the period over time covered by a report. So whenever you have a period for a trading account, for instance, you do write for the year ending 2021 December. A financial statement will always give you a period as at. So periodicity principle simply gives you reason to report results over a standard period of time. Some companies would ask you to report every 6 months. We also have what we call the monetary unit principle, which simply asserts that a business should only record transactions stated in units of currency, kwacha, dollars. In other words, the money is a basis for financial reporting, not in terms of gold or goats or what. We need to use money as principle. There's also a historical cost principle, which simply assumes that assets and liability are recorded at their acquisition price. For instance, let's say a company that has premises, which include land, building, which were bought in 1990 for 50,000. Today, its value is expected to be 100,000. So you should record, you should still record as an asset in your balance sheet as what? 50,000. This is the original cost which remains in your accounting until it is sold or written off for its useful value. So the historical cost concept must record all assets at their what? Acquisition costs. So a quick activity in 10 minutes, we need to match each of these principles with their correct definition. All right. So entity, so you can align a number. These principles that we have here, there are 5. So a company's balance sheet should report its land at the price we acquired it. What principle are we using here? 1 to 5?
5.
5, correct. A company accounts should cover a specific period of time.
3.
3, correct. Personal assets of the owner should not appear in the balance sheet.
1.
1, correct. Should separate business from the owner. A business will remain in operation for a foreseeable future.
Going concern 2.
2, correct. And the transactions should be recorded in monetary currency.
4.
4. So basically, this activity really makes quizzes 1 to 3. It's more theoretical. So these concepts are very important as you understand them, because they will really help you, especially with the quizzes. So when we go to objectivity principle, so this was just mainly meant not to forget so that we don't do a lot. So we can continue the discussion. When we go to the principle of objectivity, this one simply requires that all financial and accounting information of the company should be independent and based on evidence that is verifiable. Don't use assumptions. So the data This data will help you make information that is reliable. You should be objective. All right. Then revenue realization principle simply states that the price which you paid for the goods or services is called what? Revenue. And this principle means that revenue is realized and is recorded only when the goods are sold or services are rendered, and not when the actual cash is received. So, for example, when you supply a customer with goods worth 1,000 today, the 1,000 should be recorded as revenue as soon as the delivery is made. It doesn't matter if the client pays immediately or after 30 days. So this is the revenue realization. You only record when you deliver. The matching concept simply says costs must match the revenue earned in the same period. It is also called the accruals concept. So the costs incurred must match the revenue earned in the same period. Then also have what is called the consistency principle, which simply asserts that once you adopt an accounting practice or method, you should continue with it throughout. You should be consistent, in short. Then we also have what is called the disclosure principle, which simply asserts that a business must provide all relevant facts and information in its financial statements, and must have accompanying notes that will enable the reader to understand and make an informed decision concerning the company. So there shouldn't be any hidden information. So you should provide all relevant facts for the end user. Finally, we have what is called the prudence principle, which says that